How a low-key gold debate in early 2025 escalated into a major conflict. Futures spiked to a record $3,534 per ounce after the U.S. imposed a 39% duty on 1 kilogram and 1 ounce of Swiss gold bars. 70% of the world's gold is refined in Switzerland, which exported $36 billion in Q1 alone. Pushed back. Karen Keller-Sutter, the president of Switzerland, lost her last-minute appeal, until prices dropped to $3,407 when Trump stunned markets by removing the tariff on social media. This high-stakes conflict has the potential to alter global monetary momentum, trade flows, and reserves. One of Trump's high-stakes gold plays is lighting the fuse. Trump's high-stakes gold play, lighting the fuse. The Trump administration laid the groundwork for one of the highest tariffs ever placed on a developed country in April 2025. A 39% tax on the majority of Swiss imports. At first, gold was supposed to be exempt because of its vital function in managing U.S. reserves. However, Washington trade hawks saw a chance to test Switzerland's dependence on the U.S. market for bullion of high purity. About 70% of the world's gold is refined in Switzerland, where a large portion is recast into bars that have been certified by the LBM and sent to important financial centers. The Federal Reserve has relied on these refineries to preserve reserve quality for many years. When U.S. Customs decided that 1 kilogram and 1 ounce bars that met the COMEX standard would be subject to tariffs on July 31st, the argument became more heated. Swiss President Karen Keller-Sutter's last-minute attempt to visit Washington was unsuccessful as gold prices surged to $3,534 per ounce. It wasn't just a battle of numbers. Trump's $48 billion deficit battle was reflected in it. Switzerland's uncompromising banking secrecy and Utah's demand for transparency and origin. Furthermore, if the domination of gold in Switzerland is the catalyst, understanding why it is so difficult to replace that supremacy is the next step in this story. 2. Why Swiss gold is the system's unswappable engine. Why the system's unswappable engine is Swiss gold. Although gold has a timeless appeal, the current gold refining business is a precision process that Switzerland manages like a championship pit crew. Its 4 main refineries create bars that are so pure they meet the Fed's and other central banks' strict requirements for reserves. Other options. While Japan's refiners struggle with high local demand and logistical challenges, Canada and Australia are unable to meet Swiss throughput or consistency. Longer delivery delays, increased shipping insurance, and capacity variables like LBM certification would impede any attempt to replace with supplies, even if these producers increased capacity. However, bullion is only one aspect of the metal's significance. Swiss refineries are connected to other precision exports, such as pharmaceutical catalysts and luxury watches. Moreover, $36 billion in bullion made up 2/3 of Switzerland's U.S. currency in just the first quarter of 2025. SXS in trade. Bern has a special kind of leverage because of its supremacy, which explains why Washington's tariff announcement shook not only traders, but entire businesses. Prior to going forward, Please Hit's question is how this tariff affects the United States if Swiss gold is an irreplaceable engine. Economical drivetrain. The ripple effect of the tariff on the United States is 3. The ripple effect of the tariff on the U.S. economy. An additional $80 million from a 1 on paper. A $48 billion trade deficit makes a 2% tax or even billions from a 39% tariff seem insignificant. However, the significance of gold for the financial stability of the United States extends well beyond its intrinsic value. The Fed's reserve management, liquidity buffers, bond yields, and the dollar index are all directly impacted by gold trading. Yields can increase by 15 to 20 basis points for every $15 increase in the gold premium, increasing the value of the dollar while decreasing export competitiveness. Trump's agenda to reduce the deficit is incongruous. Political disparities increase the friction. To increase domestic supplies, Utah's mining lobby calls for rigorous origin disclosure. In order to keep expenses under control, jewelers in Illinois and New Jersey advocate for exemptions. The outcome could be decided by a small number of Senate swing votes. The burden is already felt by markets. According to J.P. Morgan, the Fed may infuse between $50 billion and $75 billion into repo markets to keep them stable, while UBS cautions that a persistent premium might favor the Swiss franc, a pricey decision that could jeopardize Trump's larger budgetary objectives. Additionally, Bern is already planning its own retaliatory actions as these economic repercussions affect Washington. 4. Switzerland's tactical counterpunch and leverage. Switzerland's tactical counterpunch and leverage. By tying gold taxes to other high-value exports like pharmaceuticals, high-end watches, and precise tools, Switzerland is engaging in a calculated long game. A bullion dispute has been transformed into a multifaceted trade negotiation by Bern. Swiss negotiators have implied that any reduction in U.S. gold tariffs may depend on decreasing taxes on industrial parts or relaxing pharmaceutical limits. One line, however, cannot be moved. Public opinion and constitutional law maintain banking secrecy. Even in exchange for significant domestic concessions, Switzerland will not compromise its financial privacy. Debate over revenue utilization has been triggered by the gold tariff. While the left supports social and climate investment, the center-right advocates for industry protection initiatives. However, there is unity across the range. No exemption from the U.S. without significant benefits. The dominance of Swiss refining supports this position. Its facilities handle more than two-thirds of the world's bullion. Bern's bargaining leverage would remain a powerful, long-lasting asset if this flow were disrupted, as it would entangle worldwide supply chains from jewelry to high-tech manufacturing. This leads us to the crucial query. Can either party afford to continue this standoff? Deal or deadlock? The endgame dilemma. 5. Deal or deadlock? The endgame dilemma. Bern and Washington are both aware of the risks to the United States of extending this impasse. High Swiss gold tariffs run the danger of securing higher prices, lowering reserve credibility, and raising borrowing costs. Losing access to the U.S. market could result in lower profits for Switzerland and compel it to reconsider its export strategy. A partial transparency agreement is a leading proposal. Switzerland provides restricted, strictly regulated access to financial data, whereas the United States relaxes origin certification requirements in return for lower tariffs. Proponents estimate that it might reduce the trade imbalance by $4 or $5 billion, reduce internal political pressures and gold premiums. Even yet, there are additional expenses for logistics, insurance, and compliance that could result in a long-term premium of $2 to $3 per ounce. The most important question is, in the age of aggressive bilateralism, has Switzerland's cherished independence turned into a liability? As of right moment, markets are still quite vulnerable. Every leak from U.S.-Swiss discussions causes gold prices to fluctuate in a matter of minutes. Any short-term U.S. victory might turn into a long-term expensive bill as long as Bern has the gold card. And that brings us to the ultimate decision in this crucial geopolitical contest. Conclusion: the high-stakes geopolitical showdown for gold. Conclusion: the high-stakes geopolitical showdown for gold. What began as a small tax dispute has grown into a worldwide power struggle. Since Trump imposed a 39% tariff on Swiss gold bars, the U.S.-Swiss commercial contacts, domestic political agendas, and international market stability are being closely examined. There are still three ways: simple origin, openness, guidelines for less expensive gold, rework reserves with alternative metals, each of which has significant trade-offs, or stand steady and bear the costs. The decision will have an impact on currency fluctuations, bond yields, and how the international community perceives America's budgetary restraint. It's your turn now. To protect Swiss gold, should the United States make concessions? Does long-term leverage come with Switzerland's superiority in refining? What impact might this impasse have on international trade over the coming year? Please leave a remark below with your ideas and experiences. It is a pleasure to hear from you. It is a pleasure to hear from you.